Okay, let's take a look at this problem, which deals with recording the issuance of common stock. During its first year of operations, Colin Ray Corporation had the following transactions pertaining to its common stock. All right, on January 10th, they issued 80,000 shares at $6 per share. On March 1st, they issued 5,000 shares to attorneys in payment for a bill for $35,000 for services rendered in helping the company to incorporate. On July 1st, they issued 30,000 shares for cash at $8 per share, and then on 9/1, they issued 60,000 shares for cash, $10 per share. So let's record some of those transactions. All right, the first case, we get cash of 80,000 per share at $6 per share, so we just multiply that out. 80,000 times the 6, and we get 480,000. And that represents common stock. So we need to record the common stock, and the common stock is equal to the 80,000 shares times its par value. And somewhere in here they tell us right there that the common stock was issued for a value of $5 per share. Oh, the common stock has a value of $5 per share. That's what I'm looking for. So if I've got $5 times the 80,000, that tells us our par value. So value per share, par value, same kind of concept of legal capital. And then the difference, of course, shows into paid-in capital in excess of par. Okay, that takes care of that entry. The second entry, on March 1st, we issue 5,000 shares to attorneys in payment for a bill of $35,000. Okay, so we need to record the organizational expense to show what the attorneys did for us, and that amount is equal to $35,000. And then we issue common stock. Oh, and I just realized above here I need to put in that account. And that account would be something like paid-in capital in excess of par on common stock. And if we only have common stock, we don't need to say that. Okay? Common stock then would be equal to how many shares? 5,000 shares, again at $5. So 25,000, and then the difference, I'll just copy from here, is the paid-in capital in excess of par. And I'll copy that from there so I don't have to type it in again. On 7/1/06, we issue another 30,000 shares at $8. Okay, so we're going to receive cash proceeds for that. The cash proceeds will be equal to the 30,000 times the $8 per share. And we are going to issue common stock and paid-in capital on this as well. So let me just copy this, and I think it'll work. Yeah. So common stock is going to be equal to the 30,000 shares at the $5 value. It's 150. And I can copy that formula again, which will compute the difference between the cash proceeds and the common stock, and that amount becomes the paid-in capital in excess of par value. Okay, now you could also calculate those paid-in capitals by actually taking the difference, right? The 8 less the $5 is $3 times 30,000, which would get you 90,000. And in this case, the difference was, what was the difference here? Well, actually, because it's not issued as share price, that one you have to compute the difference just the way we did it. All right, on 9/1, we issue 60,000 for $10 per share. So we get 600,000. And in this case, we have common stock that gets recorded at 60,000 shares times the $5 per value per share for 300,000, and the difference again is 300,000. And that one you could take the $5 difference, right? The difference between the $10, what we get in proceeds, less the $5 fair value or par value or simply value of the shares, and record that as paid-in capital in excess of par. All right, that takes care of Part A. Now let me slide a little bit and we'll tackle Part B. Okay, Part B says prepare the journal entries for these transactions, assuming the common stock is no par with a stated value of 3. Okay, that changes it a little bit, but we can still work through this. The cash amount is still the same in all of these. We get $80,000 times 6 okay, is 480. The March 1st organization expense is still the same, right? It's still going to be equal to the 35,000. And the cash proceeds on July 1st is still going to be equal the 30,000 times the 8. And the cash proceeds on 9/1 is still going to be equal 60,000 times the 10. Okay, so none of that changes, so I'll fill those in first. Now we need to figure out the common stock here. And the common stock with a $3 par value says we need to take 80,000 times that $3 value. And then the difference of, and I'm actually working the January 10th entry first. That's okay. The difference of there is paid in capital. It has to be just labeled a little bit differently. This becomes paid in capital in excess of stated value. Okay, so it's just a textual difference, but we have the same entry. The 35,000, we still would record common stock. Only this time the common stock is equal to the 5,000 shares times the stated value of $3. And again, we've got a paid in capital in excess of stated value that makes up the difference of 20,000, and that would go right there. Okay, then on July 1st we have the cash of 240,000. All right, let me drop in what accounts I think we're going to use. We're going to have common stock equal to 30,000 times our new $3 stated value. 240 less 90 gives us 150 that flows into the paid in capital in excess of stated value on July 1st. And on 9/1, we've got the same kind of events going on. We've got 60,000 shares sold at a stated value of $3. I'll just copy that formula. And we've got 420,000 showing in paid in capital in excess of stated value. And that takes care of Part B. And that's all there is to this one. Thanks, everybody.